The silver futures machine just tightened the screws at the exact moment March delivery season is getting loud, and they're pinning it on risk management. And I wasn't going to make this video. I'm literally standing here with a half-cold coffee, trying to pretend I'm off the grid for 5 minutes. And I was scrolling through the latest warehouse totals and the latest margin updates, and I thought, what is actually happening in silver right now? It annoys me, because the loudest headlines are telling you the laziest story, and I think you deserve the full story. So here it is. Today is Monday, February 9th, New York time. Comment what day and date you're watching from, because I'm genuinely curious how far this message travels. Also, quick thing, I'm running a campaign to eliminate copycat channels. If you value this content, please subscribe and comment Our John AG so the algorithm knows who you're backing. So here's what we're going to do, and it won't take forever. I'm going to break down 3 things. First, what actually sparked this new wave of March is it panic, and why the numbers people are sharing feel so extreme. Second, why a full-blown failure is not the base case, even if the market is absolutely under stress, because the system has more ways to absorb pressure than most people realize. And third, what to watch in the next few weeks so you're not just reacting to noise like it's a fire alarm. I'm not asking you to trust vibes, I'm asking you to look at the plumbing. Because based on the latest publicly posted warehouse totals and the recent margin updates, this is one of those moments where the boring details matter more than the chart. Now, if you've been anywhere near metals chatter, commodity desks, or even just your group chat with the one friend who suddenly became a silver expert, you've heard the same sentence on repeat. March is going to break the system. And maybe it will. It's not a crazy fear, but I don't think the clean cinematic collapse is the most likely outcome. Not because everything is fine, it's not. It's because this system has a bunch of levers, trapdoors, and escape hatches that don't show up in the price chart. And in a few minutes, you're going to see why the stress can be real and the apocalypse can still get postponed. So let's go back one step, because if you don't understand what delivery really means in this market, you'll get emotionally hijacked by every scary screenshot someone posts. Silver trades like it's 2 different universes pretending to be one. There's the real-world metal, bars, coins, industrial feedstock, the stuff that actually has to show up when a factory needs it. And then there's the paper layer, contracts and promises and exposure. Most people in the paper layer don't want a truck, they want a price. That sounds obvious, but it's the whole game. When people say the exchange is running out of silver, what they usually mean is the portion of metal that's tagged as deliverable right now under the rules is smaller than the pile of paper claims that could, in theory, ask for it. And that gap is where the drama lives, because the paper layer can expand fast. It's basically instant. Click, 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 position created. The physical layer cannot. You can't spawn a new bar because a spreadsheet says you need one. Now, here's why March keeps coming up. March is one of the major delivery windows on the calendar. It's a big month, and big months attract big stories. But the story didn't start with March. The chatter started because January and February reportedly got strange. January is usually not the month where everyone decides to get brave. It's normally the month where people are still pretending they're easing into the year. And yet, the numbers that have been circulating suggest deliveries were somewhere around the 50 million ounce neighborhood. Not a little higher, not kind of elevated. More like, whoa, that's a lot of paperwork turning into metal claims. And February, from what people are tracking, also looked heavy, roughly around the 20 million ounce area. But the bigger point wasn't even the raw ounces. The bigger point was behavior. An unusually large share of open contracts appeared to stand instead of rolling away. Not the normal small slice, a much larger chunk. So the question becomes, if that behavior continues into March, where does the metal come from? Now, the next part is where it gets weird, because most people think delivery means a bar physically leaving a vault and moving across the country like it's a furniture delivery. That can happen, but it's not always what it means. Sometimes delivery means a warehouse receipt changes hands. Sometimes it means a warrant moves from one name to another inside the same building. Sometimes it means the bar never moves, but ownership does. And sometimes it means a private deal happens off to the side that makes the futures obligation disappear without the metal ever changing zip code. So yes, you can see massive delivery months and still not see a parade of trucks, which is exactly why you need to understand 2 warehouse buckets that everyone throws around like they're magic spells. Bucket 1 is deliverable stock, the registered side, the part of the pile that's already set up to meet delivery obligations. Bucket 2 is eligible, metal that meets the standards, sits in approved vaults, but isn't currently tagged for delivery. It's owned. It's spoken for. It's not just sitting there like free pizza. And yes, eligible can be converted to deliverable. That's one of the system's big pressure valves. But it's not automatic. Owners have to choose, and they usually choose when the incentive is strong enough. So, when you hear registered is only around 100 million ounces, that can be true on a given day. And when you hear eligible is a few 100 million ounces, that can also be true. But the difference between those two piles is the difference between available now and potentially available if someone decides to play ball. And changing minds usually costs money. Now, before we go any further, let me add one small piece of fresh reality. The exchange has been raising margins again, more than once in a short span, and the latest bump pushed initial requirements for the main silver contract into the high teen percentage range. This matters because margins are not a headline, they're a weapon. Or, if you want the polite version, a control knob. If the exchange wants to cool speculation, it turns the knob up. If the exchange wants to keep the machine safe, it turns the knob up. And if you're a leveraged trader and they turn the knob up, you don't get a vote. You either add cash or you reduce exposure. Those are your choices. And that's why people who scream March default while ignoring margins are missing the most practical piece of the puzzle. And just so you don't think this is some rare, once-in-a-decade decision, the venue has been pretty transparent that these margin moves are being driven by volatility measures and risk models. They literally publish forward-looking volatility readings for the contract, like a what does the options market expect gauge. When that gauge spikes, the clearing side gets nervous. And when the clearing side gets nervous, they raise the collateral, because the entire promise of the clearinghouse is, we will not be the party that breaks. Here's the micro lever, and this is the one most people never talk about because it's boring and it ruins the drama. The market can pay for cooperation. If deliverable supply is thin, and a lot of people suddenly want now supply, the system can respond by offering a richer incentive for holders to tag their eligible metal as deliverable. That incentive can show up as higher nearby premiums, tighter spreads, more attractive financing terms, and sometimes just a straight-up commercial deal behind closed doors. A lot of the delivery explosion talk treats every delivered ounce as if it's a brand new chunk of metal that had to be sourced from nowhere. But delivery can be a reshuffling of claims on metal that was already sitting there. It can be metal moving from one type of holder to another. It can be a financing trade where the same bar is economically spoken for in multiple ways over time, then netted out. So yes, delivery is important, and it can reflect real stress. But it can also reflect positioning and internal transfer behavior. That's why the real tell is not just delivery. The real tell is withdrawal. Does metal leave the approved vault network? Because if it stays inside, the system can play musical chairs for longer than the internet wants to admit. And here's another piece of context that matters for the why now question. Industrial demand is not a single blob. It's a bunch of competing uses that don't pause just because traders are arguing. Solar manufacturing is a major slice, and it has been growing fast. Automotive demand is also trending up over the coming years, and projections from industry research have it climbing steadily into the next decade, with demand approaching the neighborhood of 100 million ounces a year across the automotive complex as electrification expands. Add in data centers, grid hardware, electronics, and all the little things nobody thinks about, and you get a metal that's quietly becoming a required ingredient for modern infrastructure. Now, is there substitution? Yes. Engineers are always looking for ways to use less silver per unit. Recycling can respond. But those adjustments take time. They don't happen because a March contract is loud. So when people ask, why is the silver market so twitchy? Part of the answer is that the physical side is not a slack rubber band. It's tighter than it used to be. And when a tighter physical market collides with a massive paper layer, small changes in behavior can look like a crisis. Because they can be. Now, one more important nuance about the warehouse numbers. When you see the deliverable line drop, it doesn't automatically mean metal vanished. Sometimes it's metal being reclassified. Sometimes it's metal being moved between owners. Sometimes it's metal leaving. The headline doesn't tell you which. That's why the daily sheet is a starting point, not a conclusion. And it's why, when someone says, registered is falling, therefore default, you should respond with one question. Falling because of what? Because classification can be reversed, but physical withdrawal is much harder to reverse. Which takes us right back to March. The stress is real, the math is real, but the outcome depends on human decisions. Who rolls, who stands, who pays up for availability, and who insists on taking bars out. And those decisions are influenced by price, spreads, and fear. Which is why the market can look calm for days and then snap. Margins don't create silver, but margins do reduce the number of people who can afford to stand for delivery as a protest, and that changes everything. Now, let's talk about the date that keeps popping up in these discussions, late February. You'll hear people circle a day near the end of February like it's some mystical deadline. It's not mystical, it's mechanical. As the calendar approaches the delivery period for a contract month, the market goes through a set of deadlines. First notice, last trade, assignment mechanics, and all the boring stuff that turns opinions into obligations. That's when open interest starts to matter more, because positions that remain open aren't just a view, they're a potential demand for performance. So if you see open interest staying stubbornly high as that deadline approaches, it can feel like a pressure gauge rising. But again, and this is the part that most viral commentary skips, open interest is not the same thing as people demanding bars. Open interest is potential, demand is behavior. And behavior is influenced by spreads, financing, incentives, and margin costs. Now, let me give you a simple way to think about the so-called math problem, because the internet loves a math problem. The total paper exposure in silver futures can represent hundreds of millions of ounces. That's not a conspiracy. That's just how big derivatives markets get when everyone wants a cheap way to express a view. But the deliverable pile is much smaller. So the nightmare scenario is always the same. What if even a modest chunk of paper insists on being physical? If a meaningful fraction did that all at once, yes, you get stress. You get scrambling, you get premiums, you get emergency measures, you get rule tweaks that make people furious. But here's the skeptical point nobody wants to say out loud because fear sells better than nuance. Most large players who stand are not doing it because they want to stack bars in their living room. They're doing it because delivery can be part of the financing game, the hedging game, the inventory game, the arbitrage game. In other words, they can be taking delivery inside the system. And if the metal stays inside, the system can survive longer than you think. The real break happens when metal leaves, when owners say, "No, I don't want a warehouse receipt. I want the bar, out of your network, into my custody." That's the moment that turns a paperwork problem into a physics problem. Now, do we see any signs that physical demand is genuinely tight? Yes, and this is where the fresh context matters. Silver is not just an investor toy. It's an industrial input that's getting pulled in multiple directions. Solar keeps growing, and solar uses silver. Based on recently published industry projections and annual market surveys, solar-related demand alone can land well into the low hundreds of millions of ounces in a strong year. Electric vehicles and charging infrastructure add more pull. Grid upgrades add more pull. Data centers and electronics add more pull. And the supply side is awkward, because a big chunk of silver production is a byproduct of mining other metals. So you don't just turn on silver production because price went up. That's why the major industry surveys have been flagging deficits and tightness in recent years. Now here's the twist. A tight physical market can exist at the same time as a violent paper crash, because the paper market can be forced to puke positions when margins rise and volatility spikes. And we've just watched a stretch of dramatic swings, including a sharp sell-off tied to policy headlines and margin tightening. So don't fall into the trap of thinking price down equals tightness solved. Sometimes price down just means leverage got flushed. Now, let's bring this back to March, because I don't want you lost in theory. What are the practical outcomes? Scenario 1, the market blinks. A lot of contracts roll, the incentives to take delivery are there, but not strong enough to pull metal out of eligible in size. The exchange keeps margins tight. Volatility cools. March is dramatic, but it clears. Scenario 2, the system does inventory choreography. You see eligible convert to registered. You see bars retagged. You see ownership shifted. You see a lot of activity that looks like strain, but functions like plumbing. And the public narrative becomes, see, no problem. But the cost is that the registered pile stays thin, and the next delivery window inherits the stress. Scenario 3, the one everyone is posting memes about. A cluster of big holders decides they want metal out. Not paper, not warrants, metal. If that happens, you can get a genuine scramble. Premiums go wild, spreads invert, exchanges respond, and the whole market starts learning the difference between price exposure and ownership the hard way. Now, I want to challenge one implication that often sneaks into these fear stories. The idea that a collapse would be good for regular people because it punishes the system. Careful. In a real disorderly event, the system doesn't politely hand you a victory. It changes the rules. It raises costs. It limits behavior. It protects itself. That's what systems do. We've seen this movie in other markets. Not silver necessarily, but the same pattern. Volatility spikes, the venue steps in, trading rules change, and the people who thought they were winning realize the rulebook is not written for them. So if you're sitting there thinking, I hope it breaks, just understand what that usually means in practice. More volatility, more restrictions, more weird settlement outcomes, and a lot of people getting whipsawed. Now, what should you actually do with this? First, stop confusing excitement with strategy. If you're buying silver because you think March is guaranteed fireworks, that's not investing. That's buying a lottery ticket with extra steps. Second, understand your exposure. If you hold something designed to track price, you may get price. That doesn't mean you have metal, and in a stressed moment, those two experiences can diverge. If you hold physical, ask yourself, where is it? Who controls access? And how fast can you actually get it? And yes, I know, that question makes people uncomfortable. That's why it matters. Third, watch the boring data, not the viral clips. Watch deliverable totals. Watch how eligible behaves. Watch spreads and nearby month tightness. Watch margin changes. These are the signals that tell you whether March is just loud or actually tight. Now let's talk about backwardation, because people throw the word around like it's a doomsday siren. Backwardation is basically the near-term price being higher than the later price. In plain English, give it to me now, not later. Sometimes that reflects genuine tightness. Sometimes it reflects financing conditions, convenience yield, or a temporary scramble for immediate supply. So backwardation can be a clue, but it's not a verdict. The verdict is what happens with actual withdrawals, actual conversion from eligible, and actual behavior into delivery deadlines. Now, I'm going to slow down and say something that might make both camps mad. The perma-bulls want you to believe default is inevitable. The perma-skeptics want you to believe it's all hype. Reality is usually uglier and more boring. Reality is usually the system stretches, creaks, rearranges, and survives, while the underlying physical market gets tighter in the background. And if you can hold that thought without panicking, you're already ahead of most people. Now, a quick detour on contract sizes, because this is part of why retail gets confused. A standard silver futures contract represents a large amount of metal. It's not a couple of coins, it's pallets. There are smaller versions, but the main action is still in the big contract. And that means the people who truly control delivery dynamics are institutions, industrial users, and large holders who can handle logistics. Retail mostly interacts through price instruments or through small physical purchases. So when you see open interest, don't imagine millions of people showing up with pickup trucks. Imagine a smaller number of large accounts managing exposure. That's why margin hikes work so well. They hit the accounts that run leverage. And that's also why the narrative can get distorted. A few large players can create a lot of visible activity. Now, I want to give you one more lens that is both boring and incredibly important. Why would someone convert eligible metal into registered? Because they get paid. Not always directly, but through incentives, premiums, spreads, lease rates, and the ability to monetize inventory. If the market starts offering a richer premium for immediate availability, eligible holders have a reason to step in. If the market doesn't, eligible stays eligible. So the question for March is not, is there eligible metal? The question is, will holders be motivated to release it into the deliverable pool? And that is a price question. Now, here's where I'm going to be slightly cynical, because you deserve it. If the situation were truly, obviously, unquestionably about to explode in a way that the venue couldn't manage, the rule changes would already be happening more aggressively. Instead, what we're seeing is incremental tightening through margins and risk controls. That looks like a system that is stressed but functional. It looks like a system preparing, not surrendering. And yes, that preparation can still lead to chaos, because preparation often means someone gets squeezed out. Now, let's connect this to the broader macro backdrop, because silver doesn't trade in a vacuum. The dollar matters, real yields matter, risk appetite matters. And we just watched a stretch where policy expectations shifted hard, and metals prices reacted violently. So you can have a setup where physical is tight, but price still dumps because leveraged positioning gets forced out. That doesn't disprove tightness. It just means paper markets can temporarily overwhelm the signal. And if you've ever wondered why silver can feel like it's possessed, that's the reason. Now, I want to make this very plain. A futures market can function under stress for a long time, as long as participants still believe the settlement mechanics will work. Belief is a form of liquidity. Once belief cracks, everything accelerates. That's why March is psychologically dangerous, even if the raw math is manageable. Because it's a focal point, a deadline, a story people can rally around. Now, before we get to the what I'm doing part, let me put one more piece of fresh context on the table. In recent public market updates, the deliverable registered total has been hovering around the low 100s of millions of ounces, while the eligible total sits several times higher. That mix is not automatically catastrophic, but it does mean deliverable stock is the thin edge of the wedge. It means the market relies on cooperation and incentives, And cooperation is fragile when everyone is staring at the same deadline. Now, here are 2 questions I want you to answer in the comments. First, do you think March delivery stress is real, or is it mostly a narrative that traders are using to push price around? Second, if you own silver, are you in it for a quick trade, or are you in it because you don't trust the long-term direction of money itself? And yes, you can say both. People do both. Just be honest about which one you are today. Now, let me give you a grounded way to think about paper versus physical without the exaggerated ratios that get tossed around. It is normal in modern commodity markets for the notional size of derivatives to exceed the immediately deliverable stock. It's normal because the derivatives are mostly used for pricing and hedging, not for taking metal home. But it becomes dangerous when a larger than normal share decides to convert exposure into delivery. That's why the percentage that stands matters more than the headline open interest. And that's why margin hikes are such a big deal. They don't change total paper. They change who is capable of holding paper into the moment of truth. Now, I'm going to say something that might save you money. If you can't explain the difference between a price instrument and a custody instrument, you shouldn't be making big bets based on delivery drama. Because the people who understand the plumbing will use your emotions as liquidity. They will. They always do. Now, if you're successful, share your success story in the comments so others can stay motivated. All right, let's talk about what to watch in the next few weeks, because this is where you can actually be useful to yourself. Watch whether eligible metal converts to registered in a noticeable way. Not one day, not a tiny move, a meaningful shift, because that's a sign the system is tapping the buffer. Watch whether margins keep climbing. If the exchange keeps tightening, it's telling you volatility is still a problem, and they're trying to reduce leverage further. Watch the spreads around the front month. If the front month stays bid relative to later months, that's a clue of urgency. Watch reported deliveries, but interpret them carefully. Ask, is the metal leaving or is the ownership shifting? And watch premiums in the real world. If physical premiums stay elevated even when paper price drops, that can be a sign that physical availability is the actual constraint. Now, let me address one more piece of the story, where the metal is. A lot of the approved vaulting network is concentrated in a small number of large facilities and a couple of key jurisdictions. That concentration is efficient when things are calm, but it becomes a focal point when people start thinking about withdrawal. Because the logistics of moving large bars are not simple, and the insurance and chain of custody rules matter. So when someone tells you there's plenty of metal in the vault system, the follow-up question is, whose metal is it, and under what terms can it move? Ownership matters, availability matters, and consent matters. Now, I'm going to be blunt about the derivatives critique because it's part of why this keeps happening. A futures market is useful when it helps producers hedge, helps industrial users plan, and helps price discovery. But when it becomes a giant casino attached to a relatively small physical market, you get periodic episodes where paper volume overwhelms physical reality. That doesn't mean the system is evil. It means the incentives are misaligned, and the people who run the system will protect it. So don't build your personal finances on the fantasy that the system will admit defeat in a way that benefits you. Build your finances on understanding how the system defends itself. Now, what do I think actually happens in March? I think it's going to be messy. I think you'll see volatility. I think you'll see sharp moves in both directions. I think you'll see people yelling default and other people yelling nothing burger, and most of them will be reading the wrong metric. And I think the system's most likely play is to keep the game going. Shift obligations forward, incentivize conversion from eligible, raise the cost of leverage, make delivery less attractive for anyone who's not serious. That's how you keep the machine running. Not forever, but longer. Now, if you're thinking, cool story, but what do I do tomorrow? Here's my answer, and it's not glamorous. 1. Decide if you're an investor or a gambler. If you can't handle a fast drawdown, size down. You don't get bonus points for emotional suffering. 2. Don't use leverage in a market that can gap on policy headlines and margin notices. That's like juggling knives on a trampoline. 3. If you want physical as a long-term hedge, treat custody as part of the decision, not an afterthought. 4. If you're using paper instruments for exposure, understand the rulebook and the risks of forced positioning changes when margins move. And 5. Stay curious, not panicked. Because panic is how you donate money to the people who prepared. Now I'm going to wrap this with one more uncomfortable truth. A lot of silver collapse content is designed to make you feel like you're in a movie. You're not. You're in a market. And markets don't pay you for drama. They pay you for being early, being patient, and being disciplined. So yes, watch March. Watch delivery. Watch the warehouse buckets. Watch margins. But don't let the story own you. Own the story. If you want more breakdowns like this without the recycled talking points, subscribe. And if you support the copycat campaign, drop Our John AG in the comments so I can spot you. All right, that's the map. Now let's see what March actually does. And as always, this is for education and discussion, not personal financial advice. I'm not your advisor, I don't know your situation, and you should make decisions based on your own research and risk tolerance.